Shugata Chakravarti. I'll be the instructor for the rest of the way. So you've already met Michael and Maria. So good to have you all. Thank you for coming. And so we're going to blow by some of the stuff, early stuff, just as a way to set things up for what we talk about. So we'll start with something very pedestrian, seems like, for a lot of you who've had some business classes or econ classes, as to what is a stock. Hopefully we'll look at it slightly differently. So we'll cover some of the things that I consider important about stock ownership and things, and how it fits into personal finance as a whole. All right, so this is something that I have stressed for X number of years. So I'm a football fan, and of course Super Bowl season is upon us. So this is always a good time to use a football metaphor, or football analogy. So in football, you've often heard the cliche, offense wins games, defense wins championships, and therefore the Seattle Seahawks will win it, right? No, well, we don't know. All right, and I'm a big Peyton Manning fan. So that's not from these days with the Colts, and then before that with Tennessee. But so personal finance is no different. Personal finance, you'd play offense and defense. So investing is the first module that we talk about, which is nothing but an offensive strategy, because we are using investing as a way to build our wealth. So we are fairly aggressive in terms of generating returns, and so we can think of that as an offensive strategy. Insurance is a clear defensive strategy. You're playing defense when you buy insurance, right? You're protecting wealth. There is no concept or question of making money in insurance. It's about preserving what you have and not losing what you have. So that's a defensive strategy. You've got to have good insurance strategies in place so as to avoid losing what it is you've spent maybe your lifetime building up. So that's critical. And then credit and insurance really have both offense and defense offensive and defensive components to them, because credit on one hand can help you accomplish a lot of things, which we'll talk about. But credit used poorly and unwisely can also lead you into a lot of trouble. And some of you in this room may have experienced that firsthand when you max out your credit cards and you know, a lot of things, bad things start happening, including losing, a lot of your credit scores and things like that. So retirement, of course, is offense and defense as well. Retirement on one hand is like investments. It's long-term investments. That's retirement. Retirement planning is nothing but investment planning for the long term. And of course, retirement, you've got to play some defense to protect. You don't want to aggressively take a lot of risks, and especially as you get older, you need to tamp down your risk taking so as to preserve your wealth. So there's the offense, defense built into those things. So that's sort of the offense-defense analogy around which we base this course. All right? So the other thing I want to clarify right from the get-go is, what is the difference between trading and investing? What does it mean when somebody says I'm a trader versus when somebody says I'm an investor? And the simple answer is that it is about time. If it's about what is the length of time you invest for. So traders typically invest for the short haul. So they buy and sell very quickly. Okay, so traders are like, in the extreme, they may hold a position for 2 seconds, 3 seconds before selling. So you quickly buy, take a short uptick in price, sell quickly out, and get out of the position. A lot of the algorithmic tradings now, the computer-generated algorithms do that a lot. A lot of a lot of individuals are now writing code to help them do that, quick turnaround in position. So with trading, when you're a trader, you are really interested in trading characteristics. You're less interested in what the stock is, what the company it represents, all that stuff you're not bothered about. You're simply looking at patterns in price, short-term patterns, and you're taking advantage of it as quickly as you can. Investors, on the other hand, are investing for the long haul. And so you're typically a buy and holder. You buy and then you hold for a while. And when you do that, you're typically more interested in the underlying characteristics of the company that you're investing in. Okay, so that's what your notion, you buy for the right reasons, because it may be an undervalued company, it is not being recognized, you've seen potential, you think the price will go up, and therefore you buy it and hold it, and you reap the benefits over time as the price goes up. So that's sort of when you're an investor. So now the question is, which one should you be? A big question, would you be a trader? And the answer is it's not either or. You should be both. Depending on whatever time it is, when you have some opportunities, you should be strategic, take advantage of it, take some short-term advantages in the market and make some money as a trader. But you also have to be an investor. So you need to be both. Okay, so the answer is both, not really one or the other. Okay, so simply stated, a stock, as you probably all know, but bears a quick repeat, is that it's a share of ownership in a corporation, right? So it's about owning a company, depending on the number of shares you own. Oh, Michael, we need to put in that commercial. Make a note. E-Trade commercial. Okay. All right. So this, how many of you have seen an E-Trade commercial where they don't run it anymore? They used to a while back a lot, about this woman who's having lunch with her mother in some restaurant, and a waiter hovering nearby overhears the corporate daughter's telling the mother, "Mom, I bought AT&T today," kind of thing, you know. And the waiter overhears this and thinks that she actually bought the company, and so he sort of goes into this elaborate song and dance routine to impress her because he's an aspiring actor. And it turns out that she's bought 100 shares, and she's like a 0.0000001% owner of AT&T kind of thing. So it's a joke. You're supposed to smile a bit, but anyway, it's all right. It's actually funnier when you see the video. We should link that. I'm sure there's a YouTube video on this somewhere. All right. So basically, it's an ownership, right? And so depending on how many shares you own, that's the percentage of the company. And for us, typically, when we buy 200, 300, 400, 500 shares, we are minuscule owners of the company, but you know, if you are a deep pockets person, you could own millions of shares of the company and therefore be a significant percentage owner, which means you get to have a say with the board of directors, and you get to sit in the big boy table and make big boy decisions in the company. So otherwise, you are in the small table in the back of the room, being quiet while the older elders talk around you. So. And of course, there are different classes of stocks, preferred and common. We're going to talk about common stocks in this class, although preferred stocks is a possibility. Preferred stock, very quickly, and I'm just going to say this and move on. Preferred stock, which individual investors don't really hold because it's a hybrid of stocks and bonds, which we're going to talk about bonds very soon. But preferred stocks are basically a combination of stocks and bonds. They have properties of both. And the reason why individuals don't hold preferred stocks is because you can do better by holding common stock and individually the bonds of the company. You can do a lot better than holding preferred stocks. Preferred stocks are held typically for different reasons, like companies sometimes own other companies' preferred shares because there's some tax benefits that companies get, which individuals don't. But so it's something that has properties of both common stocks and bonds. And so I'm going to leave it at that unless there's a specific question that I can address. Common stocks are when we talk stocks, when we say the word stocks, we mean common stocks. Okay, so those are what we always say. So those are the ones we will talk about primarily in this class. When we talk about stocks further, another way to think of them are as growth stocks and value stocks. Growth stocks are companies that are growing. They are younger companies. They're growing supposedly faster. When you invest in a growth stock, do not expect dividends because they do not pay dividends. The only way to make money with growth stocks is to have price appreciation. So when you buy a stock, its price should go up if you've been right in your calculations, and hopefully you write it up and you make money that way. Value stocks, on the other hand, are what is called undervalued stocks. So these are stocks that may have fallen into hard times, and if you can pick out these value stocks, in other words, they're underpriced stocks that you buy at a discount and then you make money when its true value is recognized. So shrewd investors, smart investors typically try to identify value investments. That's where you make money. Buying a stock when it's trading at its all-time high is about the worst possible decision you can make, right? It's not going to get you much. Smart ones usually buy the undervalued commodities. In fact, there's a good football analogy to this also. Good teams that have continued to do well over the last decade, the Colts, the Patriots, they've been very good at identifying undervalued commodities, undervalued players that nobody else wanted, okay? Players that other teams cut, that these teams picked up on the cheap. And then these players started performing like crazy, right? And those are kind of targets the good general managers of teams identify. All right, so that's the key. Paying a ton of money for a superstar usually leads to disaster if you've seen the NFL lately. So the smart managers, smart teams, teams that perennially feature as good teams over the last decade have made a habit out of identifying undervalued players from other teams that didn't want them, and then bring them over, and then they turn out to be these super successes, and you're paying them bargain basement salaries, which is the great thing. So then, it all fits in within the salary cap. So stocks are no different. Picking stocks and picking football players is pretty much the same deal. You're identifying undervalued stuff, right, that nobody else thinks of that well, and you buy them on the cheap and then ride up with it, all right? Okay, so when companies are publicly traded, all of us can buy into it, buy or sell those stocks because they're traded in exchanges, in regular stock exchanges. Okay, so why issue stocks? Well, for the simple reason that you and I go to a bank to look for money. It's the same thing. We as individuals or families, we have needs. Typically, a major need for us is to buy property, buy a house, maybe buy a piece of land, buy a vacation home, whatever. So that's, for individuals, that's a big need. And so we go to a bank and get that money, try and get that money in order to afford that property. Companies also have needs, except their needs are on a scale different, higher than what we need. So if we need, $250,000, they need $25 billion, right? So scale it up by a factor of 1,000 or 10,000, and then that's the need of a typical company. So for that kind of money, you can't go to a bank. Banks don't have that kind of money to lend out, okay, even if they wanted to. So for companies with their huge needs, one way to go and raise that money is to go to the capital markets and issue what is called initial public offerings, IPOs, and then raise the money that they need. Okay, so that's how companies raise big bucks. Turns out that there's another way that we'll talk about very soon, is also to sell bonds on yourself, which is lending money or borrowing money. When you sell bonds, you borrow money. So when you sell stocks, you're selling ownership. And when you sell bonds, you are borrowing money from investors. And we'll talk about bonds very soon, so I'll leave that part alone for the moment. But so companies are selling ownership in return for raising the capital they need to grow. And the downside, of course, is, okay, so you bring in money, that's good, but you also invite all these shareholders who then have opinions, right? And that can be a problem sometimes, right? Because you bring in all these shareholders, they have opinions on what should be done and shouldn't be done, and they might clash with what management thinks should be done or not done. And sometimes that can lead to problems, and therefore control is a big issue with companies. And so these shares typically have voting rights that come with it. And companies, we'll soon see, have different ways of controlling how much say investors have by issuing different classes of shares with different voting rights to them. So a lot of times you can buy a class of shares of a company where you can get to enjoy the benefits of stock price growth, but you have very little to no vote for your ownership. Okay, so, and we'll see examples of that very soon. So you wanna turn that, okay, how do I get to that, pulling up the British Spice and Tea shipping?
Oh, that's not a hyperlink. You just had a note of that in the previous.
Okay, so how do I get there?
Oh, it was just.
Okay, all right. Oh, so that's just an example okay, good. So, but they can look it up, right? The British, what is the story of the British Spice and Tea shipping? Okay. So what was the big bet? Sometimes big bets being big. Okay, then why is it there?
It was something that I brought over from the previous notes.
Okay, all right. My fault, but I will have to refresh my memory. I'm drawing a blank on why British Spice, but obviously it was. Oh yes, I remember. Okay, it's been a while. I've looked at that British Spice. So what happened was a lot of times big bets being big. So people, if you take risks, okay. So here's the story. So if you take risks, obviously there's potential of high returns. And so in the early days of maritime shipping in, say, Britain, in Great Britain in the 16th, 17th centuries, when shipping was a huge bet, a huge risky bet, because there was no guarantee that when a ship set sail for the Far East to bring back spices and all these other things that were coveted in the West and would sell for huge profits, that the ship would actually come back, because there's so many things that could go wrong. They could be they could be attacked by pirates. They could run aground somewhere. They could just sink in the ocean, and there was just a host of you could catch scurvy and all kinds of bad things could happen to you. And so that was a huge bet. So when people invested in those kind of expeditions, and you could actually take bets on those. So you could take a position. So let's say a ship is going out to the Far East, investors could put money in, and the idea was you bought shares of that that particular trade, and if they came back successfully, whatever profits were made would be shared in proportion to the shares that you had. And then if something bad happened, the ship was lost, then of course you've lost your investment. So that was the high risk, high return kind of thing. Now I remember, yes. Okay, so that was so the idea being that if you're risk averse, which we individuals are supposed to be, then there's limits to what we can make in terms of returns. So high risk, if you do not take any risks, your returns would be very minimal as well. And if you take risks, then of course returns are higher, but of course the risk of losing money is also pretty high. So that's sort of the balance between risk aversion, risk taking, and returns. High risk, high returns. No guarantees though. That's the downside. So okay, so they're public. We talked about publicly traded companies. These are ones that have shares that are traded on exchanges. Right? You also have private companies that are well known. FedEx is a very good example of a company that's not public, but you hear of it. It's a very well recognized name. You see the FedEx trucks everywhere. They're delivering stuff. They have huge jets that are traveling the world over, delivering cargo and stuff, and giving the U.S. Postal Service a run for its money. And FedEx is not a publicly traded company. It's a private company. And so there are many large companies that prefer not to go public. And the reason is that they don't have need for raising money. Okay, so that's a central reason, that they have large enough pool of deep-pocketed investors that they can get all their growth, whatever they need, from privately held shares and privately held private investors, that they don't need to go to the big markets to raise money. And the benefit of that, of course, is that when you are a private company, you do not have a lot of regulatory pressure to report your earnings and file quarterly earnings reports and do all kinds of filings with the Securities and Exchange Commission. And so that's a big plus for a lot of companies. They prefer to stay private. So it's a trade-off. And of course, you have these limited liability corporations. You have C corporations. These are different types of companies that are not publicly traded. So you can have, you have partnerships. Usually legal firms are partnerships. They are, and medical practices can be partnerships. And then what we are talking about primarily are these public corporations that have stocks trading in the markets. So here are some examples of private versus public. Some of these companies are, of course, private, but we know of them. These are companies, because there is this notion that if you're a private company, nobody knows you, whereas if you're a public company, everybody knows you, there's a name recognition. That's actually not true. You have a lot of these private companies, these are private companies, and we've heard of, at least we've heard of most of these, right? Toys R Us. I certainly, with a 1-year-old, I know Toys R Us well. And Meijer, of course, there's a new Meijer coming up on the west side. Bechtel, Cargill, of course, big grain producers. And so Mars Bars, who hasn't heard of that, And so you've got, these are all private companies, okay? So that sort of puts to question this notion we have that private companies nobody knows about. They are not. So I've told you about this. Why go public? Access to a lot of money. The downside is increased scrutiny. When you go to the public arena for funds, you also have to put up with a lot of stuff, including scrutiny, reports. There's a lot of people looking over your shoulder. If you break any kind of rules and regulations, you'll be under investigation. There's a whole bunch of stuff you have to put up with. And for those companies that feel it's worthwhile, they go public and put up with all this. All right, so here's a way for you to tell me, I went over that very fast, but if there's something you wanted me to repeat that didn't quite go over clearly, here's your chance to click in and we will see, and if, whichever one is preferred, chosen, I will cover that again quickly. So this is a new experiment this semester. So click in your answers, and you can feel free to click E, in which case we move along.
The poll's going up right now.
I've taught at Purdue for almost 20 years. I know it's hard to believe that, and this is the first time I've gotten this class. So this is a new class for me. Never been in this classroom. Okay, the polls are up. Quick, quick, quick. Otherwise, yes. How do you what? How do you connect to the right server?
It's not iClicker, it's through Hotseat.
Through Hotseat.
Your phones, your tablets, computers.
Everything is Hotseat. There you go. Okay, now how do we collate this into a percentage?
So can you show how to do the actual poll? Just click on the answer.
Yeah, just with your individual devices, you click on what the answer or what answer you'd like.
They have.
But we can see the mostly it's.
Oh, you're doing an eye test, eyeball test?
Yeah.
Oh boy. Okay, and the answer is
Mostly E.
mostly E. All right.
It seems like it's E and B.
E and D.
E and B.
E and B. What is B? Preferred versus common stock. Okay, I was afraid you might do that. All right, so very quickly, and I'm happy to give you some more material offline because preferred stock is not something we really talk about in this class. Preferred stock is really a hybrid, as I said. Preferred stock has properties of a bond and has preferred properties of a common stock. It has so preferred dividends. So preferred stock is one way of companies to raise money without having control. Preferred stocks do not have voting rights. So if you're a preferred stockholder, you do not have any voting rights. Okay, that's one way. So and then preferred dividends are a little higher over common stock dividends. So preferred dividends have to be paid. This is, sort of minutiae of things, but most importantly for this class, it's a hybrid security that really does not benefit an individual investor to hold because you're better off either buying the common stock and the bonds because it's the hybrid of these. But you, as individuals, we do not gain the benefits of either of those securities in some sense, and therefore the conventional wisdom is individuals hardly ever buy those things. Individuals buy bonds of a company, corporate bonds, or they buy the common stocks. Like I said, there's a tax benefit that companies have. When companies invest into other companies' preferred stocks, they get a tax benefit. And so there is so corporations sometimes invest in other companies' preferred stocks. And they get a tax benefit out of that investment. But other than that, individual investors, the common recommendation is do not bother buying preferred stocks because you're not really going to get any advantage that you wouldn't get without buying, that you would get by buying either the common stock or both of common stocks and the corporate bonds of that company. So that's all I want to say about it, unless you have a specific question and you can talk to me after class about it and I'll be happy to tell you more. Okay, all right, so I've told you about that, this already. Voting rights, okay, so companies have a very interesting way, even within common stocks, to differentiate across investors. And a very good example of this, an extreme example of this is Berkshire Hathaway, which is the famous company that is, for which Warren Buffett is the CEO and chairman. And Berkshire Hathaway is like an umbrella company. It has a ton of companies under the Berkshire Hathaway umbrella. One of the, I always use this as an example, one such company that you and I have probably heard of because we've seen the commercial maybe 1,000 times, and we will with Super Bowl coming up, is Geico. And you hear the gecko with the Australian accent. Well, that's a Warren Buffett company. And okay. So here is so we didn't skip by the anything, right? The chart comes on after that. Okay. So these are for those of you who are curious. We are experimenting this. These are all Mathematica notebooks. Okay. So our notes are entirely in Mathematica, this computational program, and so what we are seeing is Mathematica notebooks right now. And so I'm still getting used to that. There's a ton of advantages you can have using these notebooks. So Berkshire Hathaway has two classes of securities, BRKA and BRKB. Those are the two tickers. A class is the BRKA and B. And it is a holding company, as I said. It incorporates a number of other subsidiaries and property and casualty. Like I said, Geico is a member of that. Reinsurance and other types of companies. And this company has really done phenomenally. This overall Berkshire Hathaway has done phenomenally for its investors over the last 25 years. And so Warren Buffett's A-class shares are the ones that have the voting rights. One share, one vote, whereas the B-class share is highly diluted share. So one share might give you like 1/90th of one vote or something like that. So it's really, so basically the signal is when you buy Class B shares, you're buying just for the capital appreciation to make money, but you have no control over the company. Whereas Berkshire A class shares have the voting rights. So when you buy Class A shares, you are entitled to vote and you're entitled to do all that stuff to affect company policy. So, okay, shall we? Okay. So here's a look at Berkshire Hathaway A class shares. This is just little stuff we do to pull up the plot.
That's the current share price.
That's current. This is like right now. That's the advantage of using this program is. Okie dokie. All right, so here it is. What is the current price per share here, Michael? It is
roughly $170,000.
$170,000 a share. One share costs $170,000. Okay? That's a Class A share. That's if you want to buy a share of Berkshire Hathaway A shares, it'll cost you about the price of a house, a small house, okay, for one share.
And here's Class B.
And there's Class B coming up, very, very, and it's $111 a share. Like what? So you can guess. Okay, we'll get the plot. And that's about, well, like I said, it's about 111 or so, and you can see the same kind of growth pattern over the years. It's very steep. But this is affordable. For us common folks, we can afford to be a part of the Berkshire Hathaway dream by buying Class B shares, which is very affordable, $111 a share, $112 a share. But we have no say. We have no vote, basically. Forget about the voting. We get to eat in the small boy table. We don't. It's not the big boy table. The big boy table is the other one. The stock Class A shares, for which you have to have deep, deep pockets to put down $170,000 for one share. And the reason, so the question is, why is that share so high? Well, share price so high. The reason is Berkshire Hathaway for the last 30 years has never had a stock split. So companies historically keep the share price manageable by having stock splits. So when the company share goes up beyond a certain value, they simply split their shares to bring it back down to an acceptable trading range. Very deliberately, Warren Buffett has never had a stock split on his Berkshire A shares over the last 30 years that he has owned the company. And the reason is very simple. He wants to limit the kind of shareholders that sit on decision making for Class A shares for his company. He does not want to hear from people like you and I. He wants to hear from other professionals, other billionaires, other millionaire investors, hedge fund owners. Those are the people that he will allow to tell or discuss with him what needs to be done with Berkshire Hathaway as a company. So by keeping the share price high without declaring splits over the years, he has accomplished that goal. Another example is Microsoft. Microsoft has always been within the trading range, because since going public in '82, they have always split shares every year. Therefore, they kept their price within the common investors' trading comfort range. And the reason is Microsoft always prided itself on being appealing to the individual investor. That's the kind of shareholder base they wanted for their company, given the line of work they were in. Whereas Warren Buffett does not care for that. He cares for professional investors being part of his shareholder base, and therefore has never declared a split. So that's declaring splits and keeping the share price artificially high. You can screen out a lot of the investors that you don't want. Okay, so that's one way that companies control that. So company, when it sells shares, does it with this procedure called initial public offering, and this happens one time only. The first time a company sells to the public is through this initial public offering, and the money goes directly back to the company. Okay, so that's the first time it happens. So it's the initial public offering IPO price, and then it gets bought up by investors initially, whatever number of shares are sold. Once that happens, then the shares start trading between investors, buying and selling across themselves, and the money does not directly go back to the company anymore after that first transaction. The first time is when the money goes back to the company for the purposes of the reason why the initial public offering was done to begin with. So that's only one time. After that, that first time transaction is called a primary market transaction. After that, the company is not directly involved because the trading happens between buyers and sellers, like you and I, whatever, and we are trading with each other, and that procedure is called a secondary market transaction. And secondary market transactions, secondary markets are these New York Stock Exchange, the NASDAQ, and all these companies exchanges that we'll talk about. Those are the secondary market transaction venues. All right. So research on IPOs. Do we have any questions that I can?
So what about type A like B shares in terms of voting and what it implies?
Okay, I don't really get what is meant by splitting shares. So here's an example. So let's say a company company share price goes up to $100 a share. I'm just picking that number up. So a company can leave that share price at $100 a share. Or what they do is they say, as of so-and-so date, we're going to do a 2-for-1 split, which means that if you own 100 shares of this company share that is trading at $100 a share, after the split, you're going to have 200 shares at $50 a piece. So there is no change in your position pre and post split. It's just rearranged differently. So it's an accounting thing, if you will. First, you had 100 shares at $100 a piece. After the 2-for-1 split, you have 200 shares at $50 a piece. Double the number of shares at half the price. So your wealth before and after stays the same. But it's just now the shares are now priced lower. And the reason why companies do that, the split, as I told you, is because they want to keep the price, the share price, in this window of $20 to $60 range, because research has shown that individual investors prefer to have their stocks trading in the $20 to $60 window. And a lot of companies that want to appeal to common investors will make sure that their share prices stay in that range. The moment it starts to go out of that range, they have a split to bring the share prices trading down. Okay, hopefully that makes a little bit more sense.
Go back a slide. Yeah, somebody was asking about that.
Oh, okay. So in a secondary market, the issuing company does not make any more direct gains or losses out of those, because then the transaction is strictly between investors, buyers and sellers in the market. But the company still cares, right? The company still wants to have its share prices high. because that has a number of other connotations that we will discuss. So a company after the initial transaction still wants to have its share price trade as high as possible, because otherwise you have unhappy shareholders and a lot of other headaches that go with it. But financially, the company is not directly gaining after the initial transaction, the IPO transaction. So there's a ton of research on IPOs. A lot of academic studies have investigated this process of IPOs. And the conclusion is that IPOs are typically underpriced. So IPOs are typically sold under their fair market value, if whatever that means. And that means typically that once a share comes out in the open market to trade, they go up in price. Okay, so now the question is, why wouldn't we all want to get on? If this is known as these tons of academic studies that these are underpriced, why can't we all buy it? Why can't we all be part of the IPO? And then we'd all make money, right? Well, the problem in that logic is that IPOs are not commonly available to you and I. Okay, so they are very restricted. They are only, so the Wall Street firm that takes a company public usually takes all the shares that they're going to sell and allocate those IPOs to its most favored clients. So you have to have deep pockets and deep connections on Wall Street in order to get allocated some of those IPO shares at the IPO price. That's the problem. So in theory, it's a great thing. If you can get hold of an IPO at the IPO price, you should take it, because you're going to make money out of that deal. But it's restricted. It's not something that's commonly available to us, common folks without connections. So that's the downside of it. So if you think about it, Facebook, when Facebook came out, its IPO price was about $37, $38. And then it dipped down. It really stayed down and went down, which is atypical. It came down to almost like half of its price. It was like $17 or $18 at one time. And then now it's back up to in the 50s. So smart thing was if you had bought it in that low price, then you would be sitting on quite a bit of profit right now. So that's sort of the, but of course there's no coulda, woulda, shouldas, right? I mean, in hindsight, investments are always 20/20. I mean, hindsight is always great. You can say, oh, I wish I had done that, but that's the problem. At the time, you don't think about it, or it doesn't make sense, but after the fact. Okay, so why care? Why does a firm care after the IPO when it's not getting the money directly? It's because of these reasons, that public opinion is important. When you're in the public market space, what analysts think of you, what investors think of you, what people like Jim Cramer think of you in CNBC, those things are important. Those things are important, right? And so so you need to have public opinion on your side, because when you're a publicly traded company, PR, public relations, is a very important part of your business. You've got to have a good image. You've got to have the right people, advertising your products and things like that. So that's image management. It becomes very important. So here's the example of here's an example of Google. We took this example. This came out in 2004. IPO issue was 19th of August, and the IPO price was $85. Okay, and it's trading currently at what price?
We can go to the next slide.
I was just asking. Oh. What do you think? It's in the high $500, $600, right? Or what is it now? $1,100. Okay, well, hey, it's gone up a few dollars since I checked. All right, so that's the thing, right? So in hindsight, it's like, wow, I should have invested my entire life savings and then borrowed some and put that money in, right? And then, of course, I'd be a very rich man right today. But the problem is that in 2004, when Google came out, nobody knew that this company was going to do so well. It seemed pretty high. Even at $85, it was considered an overpriced stock. So it's one thing to go after the fact and say, oh, my God, this is like, I wish I had invested my entire life savings. I mean, hell, if I had put in, $100,000, I'd be sitting in, a number of millions of dollars right now. So, but that's the thing, is that you can't play Monday morning quarterback with investments. I mean, you make the best decision with the information you have at that point in time. Sometimes it works, sometimes it doesn't work. And so yes, the answer is, in hindsight, you should have invested, of course. But then investment is not about hindsight. It's about making decisions given what you know at that point in time. And very few people understood the business model of Google in 2004, because they were one of the early social media companies. And nobody really understood how to value this company. They had no way to value anything because they were just it was a computer algorithm that Zuckerberg had written. Right? I mean, that was it. And so to think that an algorithm ultimately would be worth $1,100 a share is kind of crazy, especially sitting in 2004. So when we didn't even have iPads, right? This was pre-iPad days. So, okay. Hot seat pause. Questions? Yes.
What about BlackBerry?
What about BlackBerry? What do you want to know about BlackBerry? It's a sad story, right?
Yeah.
BlackBerry reminds me of another company that you may have heard of called Kodak, right? Kodak had the name recognition. They had the first mover advantage. They dominated films, right? Kodak, Kodachrome. I mean, Paul Simon even wrote a song which became this incredible, part of the folklore. Who hasn't heard Kodachrome, right? Kodachrome, give us a nice. Okay. So I shouldn't quit my day job. But so that's what I'm saying. That's how recognized this brand was, and now they are nowhere. Why? Why? What did they not keep up with? What did they not recognize? Digital, yes. They refused to believe. They buried their heads in the sand, and they thought that they could just chug along the way they did always. They did not see change coming. And a company like Kodak, which is an icon, went under very quickly. BlackBerry, similar story. Executives in the US, BlackBerry was like, a term, like Google. Let's Google, it's a verb. When you become a verb, you've really made it, right? Try to be a verb in your life. That's a goal you should look for, be a verb. And you've made it. So BlackBerry they refused to see change. And they just had the ideas. I mean, initially they had the first mover advantage, and they let everybody, including Apple, come and beat them at their game. Samsung and Apple, and they just didn't know what to do. And now they're in bankruptcy. The founders are now fighting about buying the company and then starting another, very small way to get back in the game. And very sad story. New York Times had a write-up on them. The same thing. You got to keep on with changing. And there's a big article, I don't know if you've kept up with it, that Facebook. Apparently you guys are not using Facebook anymore, and Facebook is now passé, right? It's gone. And so in 2 or 3 years, apparently Facebook is supposed to have this huge drop unless they see that change and change along with it and adapt. Apparently Facebook is going down fast in the next 2 years. That's, because you guys don't think it's trendy anymore, right? Is that right? Or okay. So what's the in thing now? What's the in app? Instagram. Okay, there you go. So that's the thing. The path of business is littered with companies that had tremendous advantage. Things that companies would give both their arms for. They had this going for them, and yet they botched it up. They screwed it up. This is a family-friendly show, so I'm not going to use the F word, but it is. They just did, they did just a big-time mess, and that's the problem. So So one of the things about in business and being on top of your game is to constantly understand change and change quickly and adapt to the changing marketplace. Companies that can do well survive. Companies that don't do so well go by the wayside. It doesn't matter how famous and how well recognized you are. Market is pretty unforgiving when it comes to that. So, all right. So what to look for in some stocks? Growth stocks, I've told you, they are usually, when you're going for aggressive play stocks, these are the growth stocks. These are the new stocks. They're new kids in the block. They don't have a huge track record. So you're taking a big chance when you're investing in those. But you're doing so for the stock price growth, right? And so they do not expect dividends when you buy these shares, because for years, Apple never paid dividends. For years, these growth companies never pay dividends because they put every part of their earnings back into growth. And so they're growing so fast that they don't have a reason to pay dividends. And so companies, only after they reach a certain stage in their life cycle, start paying some dividends. Some of the profits they pay back to shareholders in the form of dividends. Value stocks, again, these are stocks that are trading currently at undervalued prices, value greater than what, or lower than what markets believe them to be. So significantly discounted from what they should be. And those are, if you can identify those are where the smart investors spend a lot of their energies in trying to identify value stocks. And just like good general managers and NFL teams spend so much of their time identifying rugby players from some, Australia or in South Africa to bring in as football players, because, what if that guy turns out to be this incredible player that nobody else wants, and you get them at very cheap prices, and then they play the living daylights out for you. So that's the same goal, right? Smart investors, smart general managers all try to do the same thing. Baseball managers, everybody, all professional teams try to do that. Find the true value prospects and pay them bargain basement prices and get incredible performances out of them. A good example for the Pacers, and this is way before your time, and I'm dating myself totally with that, Reggie Miller. If you remember, Reggie Miller was a legend for the Pacers and came out of UCLA. Nobody wanted him. He was gawky, skinny, didn't fit the mold of a basketball player, and nobody wanted him. Indiana drafted him, and then he turned out to be this legendary player, an incredible player. So those are the kind of things that you look for. Brady is a very good example out of Michigan that was a second stringer and got in, and now today he's a legend. Can't say the same thing for Manning, but that's all right. Blue chip. Blue chip is a company. Blue chips are companies. So it's a poker parlance. Blue chips are the highest value chips, and so companies that are well known, that are total name recognition, Cokes in the world, the Walmarts, the Pepsis. Those are the companies that you want. Those are called blue chip companies because everybody. Coca-Cola, everybody knows the world over. Microsoft, everybody knows. Go to the farthest corner of the globe, people will know those names. So those are the blue chip companies which are totally name recognized all over the world. They're safe. They're usually safe investments. They are in good financial shape. They're not going to have dramatic ups and downs in their prices. How much time do we have? 2 minutes. Okay. All right. I better move along here. All stocks are not equally risky. So blue chips are considered to be safe, relatively safe. Value stocks next, and growth least safe or highest risk. Within cap, so you can think also of companies being large cap, mid cap, and small cap. Large cap is large capitalization. So it's a cap is short for capitalization, and large cap simply. So how do you calculate a stock's capitalization? It's simply the share price times the number of shares outstanding. Number of shares outstanding. So if you take a company's number of shares outstanding, which you can, it's a publicly available information, and you can multiply the two, then you get the market cap. Thankfully, that number is calculated for us, and you can see it in all its glory. So a company that is greater than $5 billion in market cap is considered large. 1 to 5 billion is mid, and less than 1 billion small. Large caps are considered to be least risky. All right, I get it. Mid cap, then small caps. We'll resume from here. See you on Wednesday.